Hello and welcome to Sectors Up Close. I'm David Pollard. Today we're looking at US big box retailers and my guest is Dia Iyer, Retail and Restaurant Director at S&P Global Ratings. Consumers under pressure, a whiff of recession in the air, and to cap it all, Washington mired in a row over the nation's debt ceiling. Tough times for retailers and for their stocks, many of which wobbled earlier this month under a double hit of a dour forecast from Home Depot and April retail sales data, pointing to shoppers feeling the pinch from rising prices and from interest rates, which also just go on rising. Though the latest PCE data for April has restored some hope that US consumers may still be relatively robust after all. Walmart has been doing well, of course, groceries and consumer staples never going out of fashion, but for some of the other big retailers there are added stresses too, from the need to respond to a rising appetite for services and experiences. So what should an investor make of all that? Well, joining me now is S&P Global Ratings Retail and Restaurant Director Dia Iyer. Dia, many thanks for being with us today. Let's get an overall health check on the sector in the wake of the recent earnings that we had. How do you see the sector at the moment?
Thank you for having me. You're right. I think it's been a mixed bag this earnings season where we saw, to your point, a lot of the discretionary names, especially in apparel or in home improvement, having a much tougher time. It was something we anticipated and started hearing towards the end of last year, and we sort of started to see it manifest in lowered guidance, et cetera, for some names. I think one takeaway that we'll see is, besides airlines and air tickets, really every other discretionary area included, and retail sales in April said this, are seeing pressure that will continue. We do believe there is some chance of a recession towards the end of this year or early next year. So if we factor that in, we really believe that the guidance now is more reasonable probably than last year, where you did see a lot of misses with some of these companies.
Well, let's look at Walmart a little more closely. Has it discovered the secret of success by concentrating on what it knows best, which is groceries and staples?
Correct. So Walmart, that's right. So about half of Walmart's business is grocery. That's been such a benefit for the company over the past year. With inflation affecting food prices, there has been a meaningful trade down effect for higher end customers to come into the stores. We're seeing dollar stores also benefiting from this type of trend. To some extent, we've seen other big box players like Target also derive benefit, but Walmart's grocery business is so robust, and the way that they're able to price even before these recent price trends has definitely benefited their customer and also brought in traffic for apparel and for other areas that maybe some other names couldn't necessarily derive traffic for at this time.
Now, Home Depot was hit by a downturn in home improvement spending, which might come as a bit of a surprise. You'd think in tough times that homeowners would want to do some home repairs themselves. So what's the story there?
Yeah, Home Depot has been interesting. So I would say since, again, towards the end of last year, as the housing market slowed, as interest rates rose, we did hear this idea that it's likely that we'll see some pressure in this sector. People had spent a lot of money already on their home in the pandemic. Home Depot had one of its best years last year. So we felt like that was sort of a top. The numbers, I think, surprised people because the pace at which customers pulled back was the new news in this round of earnings. There was a sense that they do have more of a professional business versus do-it-yourself versus Lowe's. So that also, if shoppers are trading down and doing some of these renovations themselves, the contractor business might slow. So you saw all of those trends come through. They cited weather, they cited the cost of wood and lumber, deflation affecting them. So we saw a variety of pieces come together.
So you mentioned the possibility of a recession later this year. Just how robust is this sector to a possible recession?
Apparel is definitely on our mind. We've already seen some challenges there. We saw the challenges with Bed Bath & Beyond. We've seen home furnishing companies, not just improvement, but furnishing, have a really tough time, again, as pandemic spending peaked. We do think there's some benefit, as I had said, about companies with low leverage, companies that have refinanced in the past few years and have pushed their maturities out, so don't have the need to go out and refinance in this difficult interest rate environment.
One interesting story has been Kohl's, which saw its share price more or less halve last year as it got caught in a kind of a discounting spiral. But are things improving for Coles now?
Yes, Kohl's had a very tough year last year, and there were a variety of issues going on. There was activists, there was performance, there was the cutback in spending, supply chain, inventory. So a lot of things that just brought their ratings to a different place than when they started. I do think, again, all of that did teach them to be conservative about their forecasting and guidance. So since they did a good job with that, they have a new CEO, and I think they surprised to the upside. Again, in what we are calling a more difficult environment, I think all of that was very positive, and people reacted very favorably to that this year. That said, we are still watching department stores very carefully. They continue to be volatile. We still remain cautious long term about the sector overall.
So, Dia, we'll leave it there. Dia Iyer, S&P Global Ratings Retail and Restaurant Director, many thanks for your contribution today. And that is your look at US big box retailers. I'm David Pollard, and this is Reuters.